talk about in this conversation was cost of capital. So
Sure.
walk us through, because to me, this obviously, we all studied beta to derive cost of capital or weighted average cost of capital in our CFA programs or finance programs. You obviously reject that. I reject it too empirically. I mean, it just does not have any calibration whatsoever with forward required returns. So there's no, just doesn't make any sense empirically. But I do wonder how you approach the computation, the imputation of cost of capital.
Right.
So maybe
Great.
go through that.
Sure. You won't believe this, but I actually don't have a slide for that. The one topic I don't have a slide to talk about, but I'll just kind of talk through it verbally. So we start off with kind of the core premise that at a macro level, there's some base real rate of return that investors require that I don't know what it is, but from that base rate, it sort of moves up and down based on taxes and inflation expectations. So what investors ultimately care about is a real rate of return. So there's
it's that infamous R star that the central banks have been wondering what it
sure.
is for decades.
We'll just call it R star, and then that kind of moves up and down based on not as much taxes now, because now you have so much institutional dominance in the marketplace, but certainly we saw this much more when we looked at data in the 70s and 80s, that as tax rates were moving, capital gains rates were moving, that affected cost of capital. But let's just call both of those effects at the macro level. And then at a company specific level, we think, going back to one of your earlier points, what should we accept a higher reward for? Things we cannot diversify away. So at a company specific level, the two things that we as a firm latched onto that made sense to us as we were working through our logic for this was size and leverage. If I have a portfolio of small firms and there's a bad shock to the economy, all these small firms are going to get creamed. If I have a portfolio of highly levered firms and there's a liquidity crisis, almost doesn't matter what industry they're in, they're all going to get creamed. These are hard things to diversify away in terms of like big risks that can happen to a portfolio if you're just concentrated in those two spots. So that was the logic that we had. And then we said, okay, how do we get there? How do we get to an answer? And then how do we implement it? And this is what we ultimately did. We did it ourselves first, and then this is what we sold to General Motors for this larger cost of capital study globally. We wanted to treat every firm in the publicly traded market and aggregate them, do a massive pooling of accounting interest, where we add up all their income statements and balance sheets, and we calculate an economic margin as though it were one firm. And then we know the market value of their equity, we have their debt, we capitalize their leases, so we kind of know the obligations or the total enterprise value of the firm. We're going to treat this as a singular firm and forecast out economic margins that are going to converge to zero over time. And we're going to forecast out capital reinvestment rates the same way we would for one firm. Generate that stream of cash flows and then solve for the IRR that equates those cash flows to the current market value of debt and equity, and sort of get an imputed economy-wide WACC. Okay?
Yep.
We take that WACC, and then we then go and look at firms, and then intellectually, the largest, most unlevered firm is going to have the lowest cost of capital, and the smallest, highest levered firm is going to have the highest cost of capital. And
what's the scaling factor there?
It depends on their size and leverage, to be honest with you. That depends on their loading of size and leverage. Leverage has a bigger effect than size.
Okay.
And right off the bat, I don't remember the loadings. It's again, we literally did this 25 years ago, and I have.
Yeah, no, that I'm sorry, I don't mean like.
No, that's okay. But leverage has a bigger loading than size.
Okay, so that's informative. But also, like, if a company is, 10,000 times larger than another company, is obviously the cost of capital is up 10,000 times.
No, right, so, sure. That was the subjective secret sauce. that was a subjective. You have a lot with all of these things. There's it's kind of like chess. There's an infinite number of decisions you need to make, and that's why I think it's so important. If you evaluate a model, you need to see it live at a sample applied, because anyone can, someone can go and build a valuation framework today and fit all the data historically, and it works great historically. But let's see what happens when you have a tech bubble. Let's see what happens when you have a financial crisis. Let's see what happens when interest rates go to zero. I mean, you really need to see it, and you need, 20 plus years of live data to have any idea that it works. So those are things, that's the way we kind of constructed cost of capital. Every week we estimate what is the cost of capital to markets around the world. Then we assign a company specific cost of capital to discount those cash flows. Now, one of the things, I think one of the advantages of having a valuation framework that, at least to us, we've been able to prove to ourselves that it works, and we see it empirically in terms of the factor work we do and so on and so forth, is that we can then go in and start to ask different questions. We did the analysis that I mentioned with Cisco, where we figured out how much did they have to grow to justify their price. That we created this process called value expectations back in the 90s, where you back into different value drivers. But we can also say, what if we take the cost of capital and we increase it 50 basis points? And then we look at the overall market. For the overall market, on a pure, no emotion, no holds barred, you change the cost of capital by 50 bips, equity market should drop about 7%. Not too far off of where they've dropped year to date. Increased at 100 bips. Within that little span, you can more or less double. Duration is not linear, but more or less double it. So if the expectation is a 100 bip increase, and I don't think even if Fed rates went up 100 bips, right now the equity risk premium is actually quite high, very high relative, and that gets back to kind of my view of the basis of our bet for brunch in Bangkok 10 years from now. I'm kind of banking on the fact that the equity risk premium is relatively high compared to what it is historically. So even though interest rates go up, I don't think it gets absorbed one for one in equity rates. But even if it did, let's say it did, you're talking about maybe a 14% drop from where we were at the end of last year. Now you split that up by duration. Take the same list of companies, the S&P 500, and split it up on the basis of the ones that are being affected the least and the ones that are being affected the most. Just a simple 50-50 sort, right? Mm-hmm. The ones that are being affected the most, again, in rough numbers, they should be down about 8%. If it goes up 100 bips, they should be down 16. The ones affected the least should be down about 6. They should be down about 12. Even the low duration stock, again, not at the extremes, but in very rough conceptual terms, everyone's going to get hurt by rising interest rates, right? It's what I think is interesting is, I know my number, I know my estimate is absolutely wrong, but I also know through time, our valuation model does a good job explaining prices. And as we change discount rates, it adjusts kind of to what market prices have been through time. And even though it's wrong, it at least provides the basis to not have the boogeyman under the bed. How much, people, is the market going to drop 20% with that 100%, with that 100 basis point drop, 40%? I think you can at least have a basis to start having a rational conversation with clients and prospects to keep them focused on the long term that, we've had lots of 20% drops in equity in the market through time. Mm-hmm. And over time, the market tends to recover. When we look at, there's been so much chatter by the quant value people that we're at historic mispricings, right? The last graph I'll show you, because I just think it's really fun.
Let's do it. Yeah, I love it.